Hey everyone, last week the Bureau of Labor Statistics released new data that included a significant downward revision to the number of jobs created in 2024 and 2025. Prior to last week's release, 2 million jobs were created in 2024. Now that number has been revised to 1,460,000. The revision to the job creation total for 2025 was also significant, taking the total number of jobs from 584,000 to just 181,000 for the year. The metro level revisions haven't been updated yet, but I anticipate that once the numbers come in, a lot of major metropolitan areas will be in negative territory for 2025. Now, a lot of people have been asking why the revisions have been so substantial. And I'm not going to try to provide a technical answer to that question because there's a lot that goes into this, but basically, fewer companies have been answering the BLS questionnaire about jobs, and the companies that do answer right away have been skewing the data. In addition, the models the BLS uses to estimate the number of business openings and closings has been off target, pretty much since the pandemic. Then, as more data comes in from companies turning in their surveys late, the BLS adjusts their job creation numbers, and that resulted in a lot of revisions to the employment reports. If you look back at the last 48 monthly job releases, 38 of them were revised lower. Which brings me to the jobs number that was released for January 2026, which came in at 130,000 jobs. Now, that number seems a little optimistic to me, and if history teaches us anything, there's a good probability that number will be revised lower over the next couple months. So, what does the new employment data tell us about the commercial real estate market? First of all, job creation is a major driver of demand for all types of commercial real estate. And the dramatic slowdown in hiring that the US economy is experiencing will ultimately weigh on commercial real estate space demand. But I have to reiterate that despite the significant downward revisions, job creation is still positive. The US continues to create jobs. It's just at a slower pace than we've experienced in the post-pandemic era. For apartments, the slower pace of job creation suggests that net absorption will be slower than many expected. And in markets where there has been considerable new apartment development, the time it takes to fill those apartments will be longer than a lot of developers planned. That suggests concessions in those markets will remain elevated, rent growth will likely be minimal or perhaps even negative, and the leasing climate will remain soft until job creation rises. Now, in markets that have not had significant apartment development over the last couple of years, the multifamily market will be more stable. There may be a slackening of new apartment demand and rent growth may taper, but vacancy rates will likely remain relatively stable, generating modest rent gains. For the office market, the slowing pace of job creation and the decline in professional and business services positions could actually bolster space demand. As prospective employees compete for fewer job openings, their willingness to commute to the office on a regular basis will continue to fuel a rising office attendance rate. With many companies pursuing return to office strategies, this could actually elevate the demand for office space in many metros. Net office space demand has been positive for the last 7 quarters, and the weakening employment market could continue to support that trend. For retail, the reduced pace of job creation reinforces a trend that was already visible in the flattening retail sales growth rate. On a year-over-year basis, inflation-adjusted core retail sales were up by just 0.8% last year. Like the job creation numbers, the trend remains positive but slow. And that implies a relatively stable retail real estate outlook for 2026, especially when you factor in the nominal pace of retail development. That trend holds true for industrial space as well. But I want to reiterate that smaller infill industrial properties and smaller cities with minimal industrial development continue to outperform, while big box industrial properties in markets that have had a lot of development over the last few years generate more moderate performance. So, while the major downward revision to the employment numbers may be perceived as a negative or even as a headwind, in reality, they just validate the trends we were already seeing in the commercial real estate market. The job revisions didn't substantively move the interest rate climate or the outlook for future Fed rate cuts, and they did not materially change the commercial real estate investment outlook. And despite the weaker employment climate, the recalibration of commercial real estate prices over the last couple of years still creates opportunities for investors who keep their eyes on the horizon.